All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Monday, everybody. Today's August 12th, 2024, and the new week is upon us, and it's a pretty China-heavy kind of morning. We're starting a week with a lot of China stories today. 3 in particular I saw, and one of the things I do as I sit here in front of my computer day in and day out, consuming vast amount of articles, I'm always looking for patterns. I'm looking for similarities between stories. And when I see 3 different China stories the same morning, all pointing to a slowdown, it tells me, hey, things in China, there's a lot of people are out there calling a bottom in China. They're trying to say the worst is behind them, zero vid is behind them, and the property collapse is overblown. And then I see stories like Chinese regulators ordering their banks to not complete trades, to not settle their transactions. Basically, hey, all those bonds that you bought on Friday, cancel the orders. You're not allowed to settle the trades. We, the government, have decided you're buying too many bonds and you're not allowed to buy any more. When the government directly intervenes in a bond market like that, ordering banks to stop buying them, what the hell is going on over there? And I'll tell you what's going on. China has a real systemic, fundamental problem. The whole freaking economy is built on a house of cards. They're facing a deflation problem because there is a mountain, a multi-trillion-dollar mountain of debt that is going bad in China because of their property bubble, because they built entire cities nobody needs to live in. And all of those empty cities have owners. All the buildings and apartments were bought and are owned by people who owe money on them, who are never going to be able to pay them back because there's no use for these buildings. They were just built for no reason. They're like the freaking Doozlers from Fraggle Rock. They just build. They don't know why. All I know is they just build. And the only difference is in Fraggle Rock, at least along came a Fraggle every now and then who ate the building to keep supply and demand for buildings in check. There are no Fraggles in China. And so they just keep putting up these giant towers over and over again, whole cities full of them. And, lo and behold, after 30 years of that, now you got problems. And so as this debt is going bad, you've got the wealth effect is washing over Chinese consumers. Most people, their spending patterns are determined, believe it or not, by the value of their homes. When homes are going up, people feel wealthier and they spend more money. And when homes are going down, people feel poor and they stop spending. Well, homes are going down big time in China. And the average Chinese person has most of his wealth tied up in his home. And so the wealth effect is even more prominent in China than it is here in the States. So you've got big time slowdowns in consumers going on in China. Also, that's leading to consumer deflation. And when you've got a debt problem, deflation is the worst thing you ever want to have. Most people after living through inflation for the last couple of years would be like, deflation? Yes, have some. Thank you. But when you're $30 trillion in debt in the form of a housing bubble, you can't afford deflation. And so everybody is piling into the bond market in China. They are running for safety in long duration treasuries. And because they're expecting deflation, they're willing to accept a pretty low interest rate in order to buy those long duration Chinese government treasury bonds. And it's gotten so much that so much money is flowing into these bonds and the interest rates are going so low on them as the prices are bidding up that the Chinese are worried about their banks collapsing from this lopsided, crowded bond trade. And so Chinese regulators are ordering their banks to cancel trades, do over. Nope, throw it out, like just total crisis of confidence in the financial system. If they can just reach in and cancel trades whenever they want. Yikes. I mean, this is pretty much what the London Metals Exchange did with that whole nickel fiasco a couple of years ago. But they're talking about doing that with sovereign government bonds in China. Good God, what a mess over there. Also, you got OPEC coming out with a note this morning, lowering projections for oil demand growth, mainly due to a slowdown in China. Again, there's a second China story. You got oil demand worries. And there's also a story about foreign investors fleeing from China. Actually, for only the second time ever, you had net negative foreign investment in China. In this most recent quarter, $15 billion was yanked out of that country, guys. The writing is on the wall. The Chinese economy is in really bad shape. And every day there's somebody in the financial press who's out there calling a bottom in China, much like every day there's somebody out in the financial press calling a bottom in U.S. commercial real estate day in and day out. Hey, sooner or later, you're going to be right about that. I don't think it's today, that's for sure. Also going on this morning, we've got LL Flooring just announced they're going into voluntary Chapter 11 bankruptcy. They're closing 94 stores. That's one of the biggest hardwood flooring suppliers in the country. They've got about 300 stores around the country. Look, that's directly tied to the housing market slowing down. People are not buying houses. The housing market is frozen. It's not crashing, but it's frozen. And so if people aren't buying houses, they're probably not having new hardwood floors in, or if people aren't selling houses, they're not replacing the floors so the house is in nice shape before they sell it. And next thing you know, one of your biggest flooring contractors, he's going out of business. 94 stores closing. That's going to be a couple of thousand more jobs lost. Keep an eye on that unemployment rate, guys. We talked on Friday afternoon all about how unemployment is now the big statistic everybody needs to watch. It's the job market. Yes, inflation is still important. We got CPI coming up this week. I'm sure people are going to be watching it. It'll probably move markets depending on what it happens. But in my opinion, by far the more important issue now is unemployment and that R word, the recession. It doesn't matter. We all know the Fed is going to cut. Is it going to be 25? Is it going to be 50? We still don't know. But it's the recession and it's the collapse of the employment that you need to keep an eye on there, guys. Because if people lose their jobs, then they sure as heck can't make their house payments. They sure as heck can't make their credit card payments. And I don't know if you guys looked, but there's a lot of consumer debt out there. And, all this talk about the strong and resilient consumer and it's the best economy ever. Well, when people start losing their jobs, probably doesn't go that way. We also got more news out of B. Riley Financial this morning. Now, this is one I've been kind of keeping an eye on in the background over the last couple of months, really year and a half. The short sellers have been all over B. Riley Financial saying that they're up to no good over there, that there's all kinds of fraud involved with this franchise realty group that they've been working with. Well, today, B. Riley Financial stock is in the toilet. They are down, the last I checked, 45% pre-market because they just announced that they are suspending their dividend due to a loan going south to former franchise realty group CEO Brian Kahn. And that is exactly what famous short seller Mark Cohodes has been warning about for a while. So Mr. Cohodes is probably feeling very vindicated this morning on that news. B. Riley Financial probably not going to make it. We also got KeyCorp, the owner of KeyBank. Their stock is actually doing pretty well this morning because of a $2.8 billion investment from Scotiabank that's going to shore up the capital. KeyBank is one of those banks that was kind of on the fence last year with the whole Silicon Valley and Signature Bank collapse, and everybody was worried about unrealized losses from treasuries. KeyCorp was one of those companies that was on the fence, with a lot of unrealized losses. Well, this investment from Scotiabank, that is pretty much a bailout for KeyCorp, so their stock is rallying. A couple of other stories that you got to keep an eye on moving forward also. There is a possibility of a major strike at U.S. ports heading right into election season right now. There's been negotiations ongoing for the last couple of months between the longshoremen, that's the dock workers union, and the National Maritime, whatever the association is called, basically the companies that run the ports. And those negotiations appear to be at an impasse, and they're threatening to go on strike as soon as September. And you're talking about every major port from Houston, Texas, all the way up to Boston, Massachusetts, along the east and the Gulf Coast would be shut down, heading right into an election. That could definitely become a thing that would affect inflation, as shortages would almost certainly start springing up around that. And, maybe shippers would start routing around to other ports in Canada or the West Coast, driving up shipping costs. That would make a freaking mess if that were to happen. Keep an eye on that story. And, what is this? Oh, more naval assets. Speaking of boats, the United States is sending another carrier group and another submarine, a boomer, a Tomahawk missile submarine, to the Mediterranean to assist with the air defense of Israel because, well, the world just keeps getting worse. There was more missiles flying over the weekend. And so the U.S. is sending more naval assets to that part of the world, and I'm sure that's just going to end well for everybody involved. And there's another article in Market Watch this morning about school supplies and back-to-school shopping. More than 50% of parents say they're going to skip out on necessities such as groceries and paying bills in order to buy their kids the school supplies they need. More than half of parents. It's the best economy ever, where people need to make a choice between pencils at school or eating or electricity, luxury goods, things like that. It's the best economy ever. What's the matter with you plebs? You can't tell how good you have it. Why don't we shrink my big melon of a head and let's see what's going on in the market this morning, shall we? And guys, don't forget that like button for the algorithm. Really helps me out. and hit that subscribe button right next to it if you're new here, as we do this every morning. So come have your coffee with the Melonheads going through markets. And right now, stocks are up pretty much across the board. The S&P is up 10 points, or about 0.2% ahead of the opening bell. Not looking so bad this morning. The Dow is up 48 points, or 0.12% ahead of the open. And the NASDAQ is also higher ahead of the open, 31 points, 0.17%. So not a lot of movement in stocks, but up to the upside, if anything. And my dollar chart is not updating for some reason, but the DXY is up 11 basis points this morning, 103.24 for the Dixie. That's up about 0.1%. Again, not a lot of big movement. By the way, on the subject of the dollar and the Japanese yen, right now we've got the yen at 147.99. The yen is weakening this morning as you see this chart moving higher. These are daily candles, by the way. So, this is still the bounce from last week's panic in the yen carry trade. We've got the yen is weakening again this morning here. Also worth pointing out, Japanese stock markets were closed yesterday for the Mountain Day, is the holiday in August in Japan. So no updates on whatever was going on with the carry trade unwind. No movement on that one this morning. Looking over at the bond market here, we have got a pop-up ad that's in the way. Oh, come on. You're killing me, Smalls. You're killing me this morning. All right, here we go. The 30-year Treasury is up 1 basis point, 4.236 for the 30-year. The 10 is at 3.958. That's up 1.5 points. The 2 years at 4.06, up almost 1 point. And the 1 month is at 5.375, pretty much unchanged. The 210 inversion is currently about 10.5 points, not quite 11 points. And so no uninversion just yet. We've been kind of threatening, actually very briefly at one point for a couple of minutes last week, the 2 and the 10 were uninverted, but they quickly reinverted, and now the gap has grown somewhat. So still no uninversion over there. Looking over at the commodities board, we've got spot gold at 2,444, looking pretty good this morning, up $13 or about 0.5%. Spot silver is also looking pretty good here at 27.75 this morning, up 30 cents or 1.05%. We've got copper's about 1% higher. Platinum is about almost 2% higher. Same thing for palladium, up by almost 2%. And West Texas Intermediate September futures at 77.94. That's up another $1.10 this morning, or 1.4%. So oil futures are kind of shrugging off that story about reduced demand for oil, or reduced oil demand growth because of trouble in China. Now, we got a couple of commodity-related stories I wanted to talk about this morning. The first one, Canada's Barrick Gold reports a Q2 profit beat on higher output and prices. Considering what gold has done this year, excuse me, guys, considering the move in gold, I'm surprised we haven't heard more from the miners yet this year. They've pretty much been sitting out this rally. And so we're finally getting a little bit of movement here from Canada, from Barrick. Canada's Barrick Gold edged past Wall Street estimates for second quarter profit on Monday as the company benefited from higher prices and robust production. Robust production. Got to get some of that. Barrick's U.S. listed shares were up 2.1% before the bell. Hopes of a U.S. interest rate cut this year and uncertainty around elections, along with global geopolitical risks, have lifted the bullion safe haven appeal, pushing it to a record high level. The company's average realized gold price jumped 19% to $23.44 per ounce, and copper prices rose 22% to $4.53 per pound. The company also benefited from higher production at its mines in Nevada and Papua New Guinea, with gold output of 948,000 ounces in the quarter ended June 30th, compared to estimates of 905,800 ounces. So producing more gold, getting more per ounce for it. Pretty good quarter for Barrick, although the stock is up 2.9%, maybe 3%, not quite 3% ahead of the open, trading at 1792. And you can see this year-to-date chart, Barrick is actually still down year-to-date. So even though they're looking all right this morning, the miners have really sat out this move in metals here. I know we got a lot of people who like to trade the mining stocks, follow this channel. It's been a tough year for the miners. I own a few. I don't own Barrick particular. I own a few other mining stocks. They've been duds. They're just kind of sitting there, not really doing much this year. But maybe a ray of hope for the miners this morning from Barrick. Also in the commodity space, and this one is kind of having to do with this China story, OPEC slightly trims oil demand forecast, citing softness in China. Again, all you people trying to call bottoms in China, we keep getting stories like this. Every time a bottom is called, it keeps getting worse. The cartel now forecasts demand to grow by 2.11 million barrels a day, That's down from 2.25 million barrels a day previously. The Organization of Petroleum Exporting Countries slightly lowered its forecast for oil demand growth, citing softening expectations for China at a time when market concerns over the top crude importers' outlook have been weighing on prices. The Vienna-based cartel now forecasts demand to grow by 2.11 million barrels. That's per day, by the way, reaching a total of 104.3 million barrels a day. On an average, that's down from 2.25 million barrels a day in growth previously. The revision also reflects actual data for the first and second quarter. Demand is still seen at healthy levels, well above the historical average, boosted by strong air travel and road mobility, as well as healthy industrial, construction, and agricultural activities in non-OECD countries. Oil demand estimates for next year were also slightly cut, with growth now forecast at 1.78 million barrels a day from previous estimates of 1.85. Monday's report came as oil prices recorded their first weekly gains since early July last week after staging a recovery from a broader sell-off in financial markets. Brent crude, the international oil benchmark, trades around $80 a barrel, while the U.S. oil gauge West Texas Intermediate is trading around $77. And you guys can see in this chart, this is WTI crude oil here. We've been pretty much trading in this range for the whole year between the low 70s and a high of about $86, $87. It's been a pretty boring year for the oil traders here. We're just range bound, bouncing around here. Right now, we're kind of in the middle of this range. If we zoom in on this chart, you can see oil is hovering right at the 200-day moving average here. Not a lot of movement. Again, today, a little bit of bearish data on this OPEC reducing the growth prospects for next year, but oil's actually up right now. So all things considering, oil is doing pretty well. My guess is the escalating violence in the Middle East, prospects of war with Iran, more U.S. naval assets moving into the Mediterranean, more missiles flying over Israel, probably putting upward pressure on oil prices this morning. And last one in the commodities board, guys, we want to talk about Bitcoin. It's up this morning by about $889 on Coinbase, but back below $60,000 here, priced at $59,612. It was a rough weekend for Bitcoin. And the one thing I want to point out as we zoom in on this chart is you'll notice the blue line, that's your 50-day moving average, has crossed below you. The red line, that's your 200-day moving average. And that, folks, is known as a death cross. When the 50 crosses below the 200, that is a very bearish technical indicator there. So keep an eye on that one. Bitcoin has been struggling a lot in these last few weeks. Certainly did not respond well to the strengthening of the yen last week and the unwind of the carry trade. So we will keep an eye on that one as well. Also, going back over to China here, guys, this was the story that really caught my attention this morning. And this one had me going, whoa, what are they up to over there? China regulators tell some rural banks to renege on bond trades. Do over, take your ball and go home. Indian giver, whatever you want to call it. Oh my God, I just offended somebody with that phrase. Sorry, I grew up in the 80s. Look, guys, I don't know what they're doing over in China, but they're ordering banks to cancel the bonds that they already bought, just not complete the trades. Regulators have opened probes into bond trading at banks, and authorities are seeking to cool a massive bond market rally. The panic, the flight to safety in China, the Chinese regulators are trying to slam the doors on that trade. Regulators told commercial banks in China's Jiangxi province not to settle their purchases of government bonds, taking some of the most extreme measures yet to cool a market rally that has alarmed Beijing. Several rural banks failed to settle their transactions on Monday after regulator guidance to halt purchases late on Friday, said people familiar with the matter, asking not to be named, discussing private information. While reneging on trades is one way to prevent banks from taking excessive bond risk, the practice could undermine market integrity if counterparties worry that more transactions will fail. The episode underscores the challenge Chinese regulators face as they try to maintain financial stability in the face of relentless demand for bonds. And one sign of how authorities are struggling to strike the right balance, the Jiangxi officials at one point rescinded their order before it was eventually reinstated, people familiar with the matter said. So think about what they're doing here. You've got these trades were made on Friday, and then they go to settle them, and Chinese regulators say, no, don't settle them. And then they say, oh, okay, no, we changed our mind. Okay, you can settle them. And then a few minutes later, they say, nope, we changed our mind again. Don't settle them. Does that project confidence? Does that make you feel like Chinese regulators know what they're doing? Or as as our lovely Janet would say, does that make you feel that the Chinese bond market is strong and resilient? I'm sure they're saying something like that. They don't have a Yellen over there, but whatever their Yellen equivalent is, the Chinese equivalent Yellen is probably projecting something like strong and resilient, even though their actions say they have no clue what they're doing over there. The People's Bank of China didn't immediately respond to a fax requesting comment. That's a surprise. Bond yields in China have been hitting new lows for months amid economic pessimism and bets on interest rate cuts, prompting the government to resort to a slew of administrative steps to guide markets. China's rural lenders have been among the most aggressive buyers of government bonds this year. So there's a flight to safety. There's a panic. Everybody's buying bonds. They've got the deflation risk. They've got the bad debt risk. Everybody's looking for a safe haven. So they're bidding up the price of these government bonds, bidding down their interest rates. That puts a lot of pressure on banks. And Chinese regulators are worried about a banking crisis popping up out of this. So they're ordering people not to buy bonds. They're ordering them to cancel and renege on trades. And of course, they're being wishy-washy, issuing the order, rescinding it, and then putting it back in. Dogs and cats living together, mass hysteria. And while this is going on, foreign investors pulled record amount of money from China. Now, foreign investors are seeing what's going on over there, and they're saying, I'm getting my money the heck out of there. Foreign investors pulled a record amount of money from China last quarter, likely reflecting deep pessimism about the world's second largest economy. China's direct investment liabilities and its balance of payments dropped almost $15 billion in the April-June period, marking only the second time this figure has turned negative. According to data from the State Administration of Foreign Exchange released on Friday, it was down about $5 billion for the first 6 months. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data begins. Foreign investment into China has slumped in recent years after hitting a record $344 billion in 2021. The slowdown in the economy and rising geopolitical tensions has led some companies to reduce their exposure, and the rapid shift to electric vehicles in China also caught foreign car firms off guard, prompting some to withdraw or scale back their investments. And you can kind of see this chart here they're showing on Bloomberg. Foreigners pull record funds from China. This is foreign investments. You can see here, guys, this goes all the way back. The chart doesn't, but this data goes all the way back to 1990. It has never been negative before. And now here we go, just the second negative read ever since 1990. Foreign investors pulling out of China, guys. Read the writing on the wall. Things are not going well in China despite near daily attempts to call a bottom. And by the way, I just want to take a quick moment to send a shout out to all you adorable Chinese G-bots in the comments on YouTube. Every time I post something negative on China, I get all kinds of bad grammar comments about Xi Jinping is the ultimate strongest man alive and he's my hero and he's able to leap tall buildings in a single bound. You guys are adorable. Thank you for the engagement. Also going on this morning, LL Flooring files for bankruptcy to pursue a sale of the business. The slowing consumer, the slowing housing market, and the slowing jobs market all wrapped up into one in this story here. Specialty flooring retailer LL Flooring said on Sunday it had commenced Chapter 11 bankruptcy proceedings and will pursue a going concern sale of its business. The company is in active negotiations with multiple bidders and is looking for court approval for the sale of its business. In the first few weeks of the bankruptcy proceedings, it said in a statement. The Richmond headquartered firm also said that it had secured $130 million in debtor in possession financing from an existing bank group led by Bank of America. LL Flooring said it is looking to close 94 of its stores. It's one of the leading U.S. retailers of hardwood surface flooring with over 300 stores across the country. Company listed assets in a range of $500 million to $1 billion and liabilities in a range of $100 million to $500 million, according to a court filing. And strangely, LL Flooring stock is up pre-market, even though they just filed for bankruptcy. Somebody want to explain that one to me? I don't know. But up 4.29%, trading at 88 cents a share. I'm not really sure how that one works. Also going on this morning, B. Riley Financial stock drops 23%, not 23 anymore. It's a lot more than that. After it suspends their dividend. B. Riley Financial stock was down 23% in pre-market trading on Monday after the investment bank said it's suspending its dividend due partly to the fallout from a loan it provided to help the former CEO of Franchise Group acquire the company last year. The company said its second quarter results were negatively impacted by non-cash losses. Most of these losses are related to the performance of its investment in Franchise Group, Inc., and its vintage capital loan receivable, which is primarily collateralized by its equity interest in Franchise Group. The substantial write-downs during the quarter was driven by a confluence of recent events, including the impact of a meaningfully weaker consumer spending environment on FRG's business and its investments, B. Riley said. Reports of a probe by the SEC of former Franchise Group CEO Brian Kahn and his alleged misconduct at hedge fund Prophecy Asset Management have continued to create additional challenges for this investment, despite the fact that these allegations are unrelated to FRG or B. Riley, the company said, other than the fact that it's FRG's former CEO and that B. Riley has a huge investment in FRG and it's their biggest client. Yeah, give me a break, guys. By the way, shout out to Mark Cohodes, who has been all over this company for well over a year. He has been calling out this very issue, and he's been saying that they are going to be forced to suspend their dividend any day now. And sure enough, it finally happens. And look at B. Riley stock is currently down 48% ahead of the opening bell. This thing is getting crushed here, cut in half this morning. And the market hasn't even opened up yet. Guys, this company is probably not going to make it. I think by the time the dust settles from this story, we're going to see people in shiny bracelets, i.e. handcuffs, being perp walked in front of the cameras because looks like a lot of fraud going on at B. Riley Financial. And another one going on this morning, we got KeyCorp stock jumps 4.6%, a little bit more than that, as Bank of Nova Scotia to invest $2.8 billion in the regional lender. We're going to breeze through this one, guys, but KeyBank, that was one of the ones that was in a lot of trouble after last year's banking crisis. Looks like they're getting a lifeline from Scotiabank here, up 16% ahead of the opening bell. So if you were, all you regional bank watchers, if Key was on your radar, that $2.8 billion is probably going to shore things up there, as well as the falling interest rates recently is also reducing that pile of unrealized losses from U.S. Treasuries. So things are looking a little better at KeyBank this morning. Another one I want to keep an eye on here, guys. Labor talks at U.S. East and Gulf Coast ports reach an impasse. This could cause problems in the weeks ahead. A labor strike that would halt cargo handling operations at ports from Houston to Boston just weeks before the U.S. presidential election is looking increasingly likely. Dueling statements from the United States Maritime Alliance, known as USMX, and the International Longshoremen's Association on Friday indicate the two sides are still pretty far apart. USMX, which represents terminal operators and ocean carriers, said it remains ready to continue bargaining and that the latest offer to dock workers includes industry-leading wage increases and retains the current contract's language on automation. Also on Friday, the Longshoremen's Executive Vice President Dennis Daggett accused shipping CEOs of taking home bonuses in the billions and ocean carriers of raking in profits by raising rates on their customers due to global conflicts or natural disruptions. So another big labor dispute here, guys. Again, inflation is playing a role here. The cost of living went up. The wages have not gone up. And so the longshoremen are demanding the same raise that the auto workers and the airline pilots got last year and the UPS drivers got. Also, just keep in mind, those labor disputes last year, all those people did end up getting their raises. And a lot of them got laid off a few months after those raises came through. But this is a big one to keep an eye on. Also, guys, more military assets are heading for the Middle East. Things in Israel continue to escalate here. The United States is sending another carrier group. This is the Abraham Lincoln Strike Group that's equipped with F-35C fighters. They are heading over there. The Navy has ordered them to accelerate their transiting the Atlantic, so it looks like they're going to be getting there a little bit faster. Also sending additional submarines to the area. So the world continues to march backwards into World War III, guys. I'm sure this is going to end well for everybody. And the last one I want to talk about, half of parents will sacrifice necessities to pay for back-to-school expenses. Man, this one, talk about depressing. This is in Credit Karma this morning. Look at some of these stats. Nearly one-third of parents say they're unable to afford back-to-school shopping for their kids this year. 59% of parents say that due to the high cost of living, they'll spend more money on back-to-school shopping this year compared to previous years. And roughly one-third of parents plan to take on debt for back-to-school shopping, with 1 in 6 planning to take on up to $1,000 in debt for back-to-school supplies. Good God. According to a new study conducted by Qualtrics on behalf of Intuit Credit Karma, 59% of parents with children under the age of 18 say that due to the high cost of living, they will spend more money on back-to-school shopping this year compared to previous years. Higher costs create affordability challenges for nearly a third of parents who say they're unable to afford that shopping for their children this year, while especially true for younger parents. 39% of Gen Z and 37% of millennials compared to 28% and 18% for Gen X and boomers. Affordability challenges aside, parents are willing to go to great lengths to ensure their kids are set up well for school this year. Half, 50% of parents say they plan to sacrifice necessities such as groceries and bills to ensure their kids have what they need for the school year. And that jumps to 60% and 56% for Gen Zs and millennial parents, respectively. Guys, people are having to make a choice between back-to-school supplies for their kids and eating. It's the best economy ever. Can't you tell? Can't you tell when it's like, okay, we can send the kids to school in old clothes with no pencils and no notebooks, or we could have dinner tonight. What you call? What's it going to be? Yeah, best economy ever. Give me a break with that stuff. And I just want to say thank you so much. Mr. Charles Coughlin says China ate the Fraggles to extinction. Those poor Fraggles, they've been hunted to extinction. Yep, poor Red, poor Gobo, and even the Gourds. Look, Pop, I caught a Fraggle. I was so into Fraggle Rock when I was a kid. I freaking loved that show. I'm going to have the Fraggle Rock theme song stuck in my head all day. You could do a lot worse, guys. It's a good tune. Thanks a lot, Charles Coughlin. I appreciate that very much. And thank you, Viv B, who gifted 10 Nobody Special Finance memberships. Viv, that was awesome of you. Thank you so much. And KDM also did the same thing, gifting 10 memberships. And then Viv B is like, not to be outdone. Oh, okay, KDM, I'll do 10 more. 30 Nobody Special Finance memberships. Thank you, KDM and Viv B, so much. I appreciate that, guys. Hey, to you 30 folks who received one of those memberships, be sure and send a shout out to Viv B and KDM. Thank you guys so much for supporting the channel. I appreciate that very much. You guys are gentlemen and scholars and gentle ladies and scholars. I appreciate the support of the channel, guys. And thank you so much to all of my Melonhead members and magnanimous Melonheads on Patreon and YouTube. You guys are so awesome. Thank you for supporting the channel. Appreciate that very much. Thank you to my Blue Wrenches for keeping things neat and tidy in the channel. And I can hear M&J in my head saying, Jack, don't forget to tell them to like and subscribe one more time before you sign off for the algorithm. So yeah, guys, don't forget, like and subscribe while you're at it so M&J doesn't yell at me. I'm just kidding. She doesn't yell at me. Thank you guys so much. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.